Friends, in the part 1, we discussed threat in detail, and the part 2, we discussed IPC as well as the non-fund based facilities to non-constituent borrowers as per the latest guidelines. Now, in this part 3, being the part 3, we would be discussing on factoring and forfeiting and the RBI guidelines thereof. Friends, what is meant by factoring? Factoring is an agreement in which the receivables arisen out of the sale of goods or services are sold to a third person, to a factor, that is a financial intermediary. It is sold to a financial intermediary, that is a factor. So that is known as the factoring. But in this factoring, what is its peculiarity? The legal point, by doing this, selling this one to the factor, the title to the goods representing the receivers passes to the factor. Title passes to the factor. And the banks, as per the RBI guidelines, banks are permitted to undertake factoring departmentally without RBI permission. This also, the blanket permission is given for undertaking this kind of factoring services to their customers, factoring services, but that is also subject to certain compliance of certain conditions or compliance of certain conditions, which are brought out clearly, explicitly by RBI. The first one is that, as you may remember, earlier also in the IPC and even for non-fund based facilities, the non-constituent borrowers, he said that there must be a duly approved policy. Duly approved in the sense it is a policy duly approved by the board of directors. Board, that is the highest authority of any bank. The board approved policy should be there. First one, for carrying out the undertaking this kind of business, means factoring business departmentally by the banks. So second criteria would be, when factoring the banks consider, factoring can be 3 types. It may be with recourse or without recourse or limited recourse. This is very special feature. In the factoring, 3 types, and all other transactions, you remember in the trusts we discussed, it should be without recourse to the seller, MSMEs. But here it may be with recourse, it may be without recourse or limited recourse basis. Then the most important is risk management. Because in this policy, first policy itself, the policy should contain, first one, this board approved policy we discussed, the policy should contain what are the areas wherein the risk, there is credit risk involved, and as against that, what would be the mitigating factor. That is when the policy framed, policy duly approved, this clause should be there. That is a risk as well as the risk mitigating factor. In this case also, the approved policy should contain both the risk relating to undertaking this business as well as risk mitigating factors, so that the business can be taken forward further. Okay. Then comes risk management. Risk management, when we say banks presently, whatever transactions we take, they are all risk prone. Earlier the banks, we say that it is a financial intermediary. Now the days have come, it is not a financial intermediary. We can say that it's a risk intermediary rather than a financial intermediary. And here, in the while undertaking this factoring services, as per the earlier guidelines, there must be some upfront. How much would be the prepayment can be affected under this factoring? Normally, banks won't consider 100%, so that always a portion of the fund, portion of the receivables should be taken as a margin or any we can say that upfront margin or some other cushion. so that in case of any deficiency at the time of final payment, it can be made good from these proceeds. That is earlier, as per the earlier guidelines, the banks cannot consider beyond more than 80% of the invoice value or the receivables value by under the factoring. But with the this matter has since been reviewed, and now, as per the latest guidelines, the banks undertaking factoring services departmentally can take the call. Means they can take discretion is given to the banks based on their assessment of the credit worthiness, credentials, assessment of the appraisal, and all other kind of commercial considerations, all other factors taking into account, they can consider they can fix upfront. They can fix what would be the prepayment amount that can be considered under the factoring services. Factoring is, remember, it is purely domestic sales. Now there is adequate margin. The prepayment amount that is since relaxed, the discretion is given to the individual banks, because this is a part of the reforms. In any lot of reforms are taking place in the bank in this one. So this is also part. Just we discussed about the non-constitutive borrowers. It was not there. Now it has been permitted to the banks for doing this one, but with the subject to conditions to take care of the risk factor. Here there is a margin requirement that also relaxed. In the sense, depends on in the sense we can say that it is at the discretion of the individual banks. Okay, then proper assessment of the credit worthiness. That is means credit worthiness, due diligence, credit means customers' antecedents, or the credit worthiness, whether the borrower, whether the person, the party on behalf we are doing this, bank is doing this factoring, is adequate, financially sound to make good the bank in case of need. Now, due diligence, as we said, due diligence should be carried out in all the ways. That is the person, the behind the unit, then properties and other things, papers and other things should be. There is a due diligence to be carried out, and other commercial considerations. Based on these things, the margin can be relaxed. Okay. Now, another area to be seen is credit appraisal on the debtor. The person on whose behalf bank is doing this factoring business, they are the debtors. So, unka thorough credit appraisal would be carried out, and this is a part of the working capital banks are considering. So, appraisal would be considered. Appraisal would be carried out, taking into account the working capital limit, and suitable adjustments would be made for considering the factoring facilities also. Because this is another way of, or we can say that dispensation of the credit in respect of working capital finances. So that appraisal should be there, proper appraisal as per the laid down guidelines of the bank. Then factoring should be exclusively for the genuine trade transactions. It should not be any other purposes. It should be for the genuine trade transactions, because as I told you, it is an agreement arising out of what? In the receivables, out of the sale of goods or services. These are genuine trade transactions should be there. Suppose, and here again, taking the risk factor. Here we say that trusts, we say that it should be without recourse. Here we have seen that it can be with recourse, without recourse, or limited recourse also. So the without recourse in that case, as per the policy, most of the banks will always fix per party limit, per debtor limit, so that unnecessary concentration, that exposure now, concentration risk can be taken by fixing the per debtor limit. Per debtor limit where without recourse. With recourse, then it is a risk on the assigner. So that problem won't be there. But without recourse, it should not bounce on the bank. So the per debtor limit would be fixed. Then another area is This factoring is also to be treated at par with that of other loans and advances, so far as prudential guidelines are concerned. What is a prudential guidelines? We can call it as the delicacy norms. That is 90 days, beyond the 90 days, it should be treated as non-performing asset. So here, so for the factoring, if the payment is not received within 90 days from the date of, from the due date, we can say the due date. After the due date, within 90 days, if the payment is not received, that amount is to be classified as non-performing asset, NPA, irrespective of whether, irrespective of when the receivables have been acquired or taken for undertaking these factoring services. So it is strictly as per the loan or other advances, cash credit or other advances. 90 days criteria would be there. Then delicacy treated as par with the delicacy norms applicable, that is 90 days criteria. Non-payment within 90 days, irrespective of when the receivables are acquired or factoring, whether or with or without recourse. With or without recourse also, the 90 days delicacy norms are strictly to be followed in factoring also. Then in that case, if it is with or without recourse, the entity on which the exposure is taken, that is a debtor, that is to be booked, that is shown as a non-performing asset. On whose behalf the factoring has been done, that is to be shown as the NPA. Then exposure norms. When we talk about the exposure norms, that is, we have to think about the capital, that's capital funds. In the case of individual borrowers, it should not exceed 15% of the capital funds. And in the case of the group, it should not exceed 40% of the capital funds. Group and overall exposure. That should be with that exposure should be seen. It should not exceed the overall bank's position as on the previous, that is 31st March of the previous year. It should not exceed the capital funds so far as the exposure is concerned. Then another exposure norms is that suppose it is with recourse. That means bank has got a recourse. That is to go back to the debtor. Then it can be against the assignment, that is exposure on the assigner. Exposure on the assigner, that on whose these bills are raised, which has been which have been taken up for factoring. So it should be the risk or it is exposure to be treated on the assigner in the case of with recourse. And without recourse, it should be exposure on the debtor. That is on whose behalf we have considered the factoring facility. So this is the difference between these two. Suppose international factoring or international forfeiting or this one, then in that case there is a risk on the import. In the case of international factoring, import factor, there is a risk exposure on the import factor, on whose behalf this exposure, this business has been undertaken. That is for international factoring. Then, as I explained earlier, that exchange of information. Then it should be exchange of information with the CIC and CIRSAI also. CIRSAI on why this it should be exchange of information among, first of all, among the banks. If some other banks are also involved, the information should be shared with other banks so that it will prevent the double financing from taking facility from one bank as also same facility from other bank. That should be avoided. So exchange of information. Then this data, everything will be furnished to the credit information companies, that is CACs. That is 4 companies are there. That is RBI has approved. That we already talked a little bit in the previous part 2 we discussed it. Then CIRSAI, as per the CIRSAI, any charge, whether it is a mortgage charge or hypothecation charge or the charge on the intangibles, all the non-fund based also, all the charges to be registered with the CIRSAI, that will also take care of in case any double financing or any that is say on the same security finance has been considered by any other any other institution. So CIRSAI assistance is there. So the CIRSAI assistance can be taken. Then these are the RBI guidelines. Then submission of the credit information, as I told you. Then adherence to KYC, FEMA guidelines. KYC guidelines, AML guidelines, then CFT guidelines, and FEMA guidelines, Foreign Exchange Management Management Act guidelines. All the things have to be taken care of. This is in brief about the factoring. And factoring can be different type of factoring, as I told you. Then bank can also consider factoring other companies. The NBFC factor, they have identified NBFC can also do the factoring. So those NBFC factor can be financed by the bank. But the guidelines say that in that case, the NBFC the assets consider the total assets, the assets considered under the for the factoring should not be less than 50% of the total assets. Total assets mean at least it should be factoring business. Minimum it should be 50%. It should be minimum 50%. It should not go below 50%. And the income should be should not be less than 50% of the total income of the particular entity. That is, at least 50% of the total asset should be from factoring business, and the income earned or income accounted should not be less than 50% of the total income. These are the conditions to be fulfilled. Then the banks can finance the factoring companies also, factoring entity. That is mostly the NBFC factor. Okay, at least 50% of the gross income. Then priority sector. We have seen that TRUDS, all transactions on the TRUDS platform that is exclusive for MSMEs are to be treated as a priority sector lending targets for the banks. For priority sector lending target for the banks. Same thing, factoring with recourse basis where assigner is MSME. If factoring is carried out, but the assigner is MSME, in that case, it can be considered as a priority sector. Factoring through the TRUDS we already discussed. This is about this factoring. That is, please remember that it is for normally for domestic sales only factoring is taking place. And factoring again, not only this purchase of the receivables, but also the factor will take care of the account maintenance, collection. All the things are being taken care by the factor. Whereas when we talk about the forfeiting, we will see that it is not there. So this is in a nutshell about the factoring. Now coming to what is forfeiting. Forfeiting is basically it's a financing of the financing of the receivables pertaining to international trade. Whereas other one was a domestic, here it is financing of the receivables of international trade emanating from the international trade. Then sale is what is actually the sale is supported by the sale is, in this case normally what is a modality we are going to explain, but here first of all we remember that it is for international trade. Okay, and sale is supported by bill of exchange or promissory note. Sale always bill of exchange and promissory note. And in India, Exim Bank and authorized dealers of category 1 are permitted to carry out these forfeiting transactions, forfeiting business independently. Okay. Now, how this forfeiting business or forfeiting transaction can be undertaken? They can be, first of all, assume that a sale has taken place. Sale of goods on deferred payment terms. Sale means it's a importer maybe in abroad. Sale of goods on deferred payment terms. And it may be either the promissory notes can be raised by the seller as well as the purchaser, that is the importer. The promissory notes by the importer or by the exporter, both the ways. But the promissory notes are basically first it should be the promissory notes or a bill of exchange are guaranteed by another bank. It not necessarily that it should be the imported bank. Any other bank from abroad, they will guarantee. And that particular bank is known as AVAL, AVAL. AVAL, they guarantee the promissory notes. And these different promissory notes, different due dates. And all these promissory notes are being guaranteed by another bank, and not necessarily importer bank, but that is known as AVAL. Then exporter, what the exporter will do? Enter into forfeiting arrangement with a bank. Then forfeiter wants, because they want the money, though they will make an arrangement with the bank. The exporter sells the avalized bills to the forfeiter. Forfeiter, whoever is purchasing, or we are the forfeiting, the bank sells. The parties exporter sells to the bank. Then the exporter sells the avalized bills to the forfeiter. They are selling, and the bills can be either retained by the forfeiter, or they can the bills are without recourse. Here you remember, these are also the bills are without recourse and at a discount. The bills will be discounted. Payment is made immediately. The bills are without recourse and at a discount. And payment मिल जाता है. Then the forfeiter, there is an option is given to the forfeiter. Forfeiter may hold the bills, the avalized bills, guaranteed bills, or they may dispose it in the secondary market to just supplement his fund. He can do it. And this is the way the things are taking. On the due date, the money would be received. This is the modality how the forfeiting normally takes place. Okay. Then we can discuss on export factoring. Another type is export factoring on non-recourse basis. Non-recourse means without recourse. Here the banks, the conditions are there. Bank can consider. Also, there should not be any overfinance. Proper assessment. That's what initially I said, that assessment, appraisal should be carried out. And in this kind of businesses, it is a part of the working capital, and the bank should see that there should not be any overfinancing. Then working capital reassessment, because when factoring or forfeiting, that fund is being made by other mode of dispensation. So the fund is getting working capital requirement would get reduced. So that is why there is a proper other reassessment of the working. Then again, it is a genuine trade transactions only, and there should be genuine trade invoices or bill of exchange or promissory notes. Then arrangement with the voter for the import factor for an evaluation of the factor for evaluation, etc. These are the things to be taken care at the time of carrying out this forfeiting exercise or forfeiting business. Then again, in all the cases, we have to comply with, the banks are required to comply with KYC and due diligence of the exporter. Due diligence on the exporter. So if we are doing this forfeiting, we have to take the KYC guidelines. We have to see that meticulous compliance of the KYC, AML, CFT guidelines, which are being issued by RBI from time to time, that should be meticulously complied with. And the due diligence, as I already explained, on the exporter also to be seen. Then after factoring, export factor reports to RBI, because that transaction is a foreign exchange transaction. So after the completion of the transaction, the transaction should be reported to RBI in a particular section. That is for forex business. It should be reported to RBI. That will be taken care in their record for collection and dissemination. Okay. Then we have seen what is actually factoring. Then we have seen what is forfeiting. Then what are the differences between these two? Any differences are there? Both are very much akin to each other. Yes. First one I said First one I said one is a domestic one. Other one is that factoring is concerned. It is a domestic for domestic trade, whereas forfeiting is for international trade. That you are getting it. Second one is that the forfeiter discounts the entire amount, whereas in the case of factor, earlier it was up to maximum 80%. Now relaxation is there, but still banks will also see taking account of various other factors, appraisal, then commercial consideration, then antecedents, all the factors taken. Bank will also fix some margin, most of the cases some margin to take care of any deficiency at the time of the final settlement. So whereas in the case of forfeiting, entire amount is being paid without recourse. Then forfeiting is a pure finance arrangement, whereas factoring, as I told you, it involved ledger maintenance, then involves ledger maintenance, collection, etc. This is one of the features of the factoring that involves both, in addition to this financing, that ledger keeping, then collection, etc. Then factoring is essentially a short-term finance, whereas forfeiting is a longer period, because there is an exporter. Exporter is going to abroad, some other sender. From there, this realization, everything to come. It involves time. Involves time. So it is a longer process. It extends credit over it's a longer period in the case of forfeiting, whereas in the case of factoring, it's a short-term nature. So we have seen that what is factoring, what is forfeiting, and these are all RBI guidelines, and what are the differences between factoring and forfeiting. And that is, we said that it's a domestic, and other one is international, then it's short term, other one is a long term. Then another is forfeiting. There is a protection by the avalized bank. There's a guarantee is there, protection by avalized bank. So protection is there, whereas in the case of factor takes the credit risk. That is one of the important points. One is the guarantee is there. Second one is the factoring, there is no guarantee. So entire risk is taken by the factor himself. Forfeiting is a pure financial, factoring is essentially short term, whereas forfeiting usually extends longer period. I hope that you have got a fair idea about this factoring, and as well as this one forfeiting as well. Along with that, we discussed a little bit on the difference between these two facilities which are being considered by the banks nowadays. Okay. With this, we can conclude this session. Remember, we have divided into three parts. Part 1, we dealt with the trades. Part 2, we dealt with the IPC and non-fund based facilities with the non-constant borrowers. And